Wow, the end of 2025 has been an absolute whirlwind for the tech and fintech markets. I mean, in just the last 48 hours, we've seen these massive government decisions, huge capital moves, and some really sharp strategic pivots that are, no joke, setting the entire stage for the year ahead.
So let's just cut right through all the noise. What was the one thing, the single biggest story that was driving all this activity? What was the real catalyst here?
Well, here's a hint for you. It wasn't some flashy new AI tool or a blockbuster earnings report. Nope. The biggest story actually came from a place a lot of investors tend to overlook, a regulatory body down in Washington, D.C.
And that's exactly where we're going to start. Because this single decision, it was like a starting pistol. It just set off this huge chain reaction across the market, and it made it crystal clear who the winners are heading into the new year.
Okay, so the concept at the heart of all this is something called Earned Wage Access, or EWA for short. The idea is actually super simple. It's a service that lets you get paid for the hours you've already worked, instead of having to wait for that official payday. And here's the crucial part. On December 22nd, the Consumer Financial Protection Bureau, the CFPB, officially ruled that these EWA services are not traditional credit or loans. Now, this is huge. This is a monumental decision because it removes this massive legal gray area that's been hanging over the entire fintech industry for years.
And boom, we can see the immediate winners right here. For a company like Chime, their whole service is basically built on this model. This ruling just vaporized a massive legal threat overnight. It's no wonder analysts are calling them the maximum beneficiary. And it also sends this really positive signal to companies like Affirm, which is in that buy now, pay later space. It kind of suggests that regulators are finally taking a more modern approach to all of this new financial tech.
So, with that big regulatory fog lifting, what happens next? Well, the companies with deep pockets are starting to get really aggressive. They are not just sitting on their cash anymore, they're putting it to work.
First up, we've got Block. You probably know them as Square. They just announced a massive $5 billion expansion of their share buyback program. That's a huge amount of capital being deployed just to boost shareholder value. So why now? This quote really says it all. Look, a buyback of this size is one of the strongest signals management can possibly send to the market. They're basically screaming, hey, we believe our stock is an absolute bargain right now, and we're putting our money where our mouth is. And then you have Rocket Companies. They just extended a major financing agreement, bringing their total available funding up to a staggering $25.9 billion. Let that sink in. That's not a safety net. That is a full-on war chest. In this next one, this illustrates a completely different kind of spending. Hims & Hers is investing $200 million, not in stocks, but in actual steel and concrete. They're building this massive new facility out in Ohio, which is a clear bet on physical infrastructure to power their digital growth and just meet this incredible increase in demand they're seeing. Okay, so we've got companies spending with a ton of confidence. But what are the professional analysts saying? What are the folks on Wall Street thinking? Well, by looking at their most recent calls, we can basically get a scorecard of their biggest bets for the year ahead.
And this table gives us a fantastic snapshot. You see Bank of America giving this huge vote of confidence in Doximity. You see Barclays getting really bullish with their upgrade for Robinhood. But then on the other end of the spectrum, you've got Barclays taking a much more cautious, kind of wait-and-see approach to the telehealth company Teladoc.
And let's just visualize for a second how bold that Doximity call really is. An $82 price target? That implies a potential 88% upside from where it's trading right now. That's not just optimistic, that is one of the most aggressive calls we have seen on a major tech stock this entire quarter.
Sometimes the biggest vote of confidence doesn't come from a single analyst, but from the market itself. And on December 22nd, Carvana was officially added to the S&P 500 index. That's huge. It puts them into countless index funds and basically gives them a promotion to the big leagues.
But, it's not all smooth sailing and popping champagne corks. While some companies are riding these amazing tailwinds, others are facing some pretty serious strategic challenges. In this environment, success is all about adapting, and some companies are learning that the hard way.
Just take the story that's playing out right now at Instacart. So they were using this pretty sophisticated AI tool to help grocery retailers test out different prices on their platform, which, by the way, is a fairly common practice in e-commerce to find that perfect price point.
And right here, we hit a classic tech dilemma. The goal was totally reasonable. Help retailers sell more stuff. But the problem was this growing backlash over price transparency, which caught the attention of consumer groups and, even more importantly, the Federal Trade Commission, the FTC. So what was the resolution? Instacart caved. On December 22nd, they announced they were shutting the whole AI price testing service down completely. It's a major strategic reversal, and it's a key lesson for everyone in tech. Innovation without transparency is a really, really risky bet. And you can see this pressure reflected in where the big money is flowing. In just the last 48 hours, major asset managers have been buying up shares of Zillow and Dutch Bros. But at the exact same time, one of Wayfair's biggest investors dumped nearly 90% of its position. The smart money is clearly picking its spots.
And here's one final signal to keep an eye on. What are the insiders themselves doing? Because even as all this good news is breaking, we're seeing planned sales from a Coinbase co-founder, from the COO of Carvana right before its big S&P 500 debut, and even a director at Chime right after their huge regulatory win. Now, a lot of these are pre-scheduled, but the timing is definitely something for investors to watch closely.
So after all that, what does this whirlwind 48-hour period really tell us about the road ahead for 2026? Let's just boil it all down to the key takeaways.
There are really three dominant forces at play right now. First, regulation is no longer some vague threat on the horizon. It is actively creating clear winners and losers today. Second, companies with strong balance sheets, the ones with all that cash, are getting really aggressive. And third, strategy matters more than ever. The market is rewarding agility and absolutely punishing companies that misread the room on big issues like transparency.
And that leaves us with one final big question. As we head into 2026 and these three forces, regulation, capital, and strategy, all collide, which one do you think is going to be the most important? Which one is going to create the next big winner? The answer to that is probably going to define the entire year. Thanks for watching.